The euro slid to a 20-year low against the US dollar this morning, trading at below 99 US cents. It comes off the back of last week's announcement from Russia that it would shut off gas deliveries to Europe indefinitely. Well, with me now is Vicky Price, Chief Economic Advisor at the Centre for Economics and Business Research. Vicky, great to have you with us. Now, we've been seeing this downward trend with regards to the euro against the US dollar ever since Russia started its full-scale invasion of Ukraine. Do we have a clearer idea? Do we know how low the euro could go?
We don't. I think much will depend on what happens to interest rates, frankly. We're going to have the European Central Bank making a decision this Thursday, and the expectation is that they may raise rates quite considerably, certainly by 50 basis points, maybe even more. And if that is indeed what happens, then we might see a little bit of greater sort of stability coming to the euro, because the main issue has been the differentials between interest rates in the US, which was happening even before the Russian invasion in the Ukraine. But the ECB, of course, as we know, has lagged behind to a considerable extent the trend of other central banks. And it's one of the reasons why the euro looks weak at present. There is another reason, of course, which is the expectations for low growth in the European economy. It's affecting some countries more than others. But what we've seen is not only very high inflation across really the EU, but particularly, of course, in places that are quite near Russia, such as the Baltic states. But what we're also seeing is huge re-evaluations of economic prospects, with forecasts now showing possibly a recession in Europe coming on, and even in countries like Germany, which of course is particularly badly hit by gas not coming as it did before from Russia.
Well, you mentioned that meeting, the upcoming meeting of the ECB on Thursday with the prospect of raising rates. I just wonder beyond that how much wiggle room there actually is. I guess there's a concern, with how much further the central bank can actually go in tightening its policy if we see the energy crisis severely disrupt economic growth in the region. I guess that's the next question.
Absolutely. And I think there is a danger. If you remember back in 2011, when things looked like they were getting better, when we were leaving the original financial crisis, interest rates were raised twice by the European Central Bank. And yet we discovered very soon afterwards that during that period, the Eurozone was already in recession. So that had to be reversed. So there's always this problem that what you will be doing really by raising interest rates, particularly if they're raised quite significantly, is seriously affect growth. On the other hand, you do need to do something about inflationary expectations right now. I mean, inflation being as high as it is, sort of 9% or so in the Eurozone, which is, of course, the highest we've seen in quite a lot of decades. And that needs to be tackled. And the ECB needs to show that it's serious about this. But it has to also be very, very careful that it doesn't engineer that way a real slowdown, if not a serious recession in Europe.